Hello, I'm Earl Taylor, the Chief Marketing Officer at the Marketing Science Institute. As many of you know, nonprofit MSI serves as the bridge between marketing theory and business practice, and our goal is to move the needle on significant marketing problems. We do this by funding research by leading academics worldwide on topics voted by our 70-plus corporate sponsors and disseminating that research through members-only events and a variety of publications. I'm very pleased to welcome you to another MSI For Members by Members webinar. This is a series of webinars on subjects related to MSI's current research priority topics. First, I'd like to point out the chat with presenter function in the left-hand corner of your screen. Please use this feature to send through any questions you have for David during the presentation. We'll gather questions and have a brief Q&A session following the presentation. Now I'd like to introduce you to today's featured speaker. Dave Stewart is President, Professor of Marketing and Business Law at the Loyola Marymount University in Los Angeles. He has served as faculty at the University of Southern California, University of California, Riverside, and Vanderbilt University. He is the current editor of the Journal of Public Policy Marketing and has previously served as editor of Journal of Marketing and the Journal of the Academy of Marketing Science. He has over 250 publications, including 12 books. He is an expert in many areas of marketing, including strategy, decision-making, effectiveness of marketing communications, and public policy issues related to marketing. He won the American Marketing Association's Lifetime Achievement Award for contributions to marketing and public policy, and he has served as an officer in numerous professional organizations and consulted with many different companies. He holds an MA and a PhD in psychology from Baylor University, and in the spirit of full disclosure, I have to say that Dave and I served together on the Marketing Accountability Standards Board, where Dave was very instrumental in some of the work that he'll be sharing with you in a moment. The Marketing Accountability Standards Board, as you will learn more in a moment, is an organization that was founded in part by MSI. We're very pleased to be a part of that organization and continue to support it. And with that, I'm going to turn things over to Dave to tell us about accountable marketing.
Well, thank you. Well, delighted to be here. Good afternoon or good morning, depending on your time zone. What I would like to spend some time with you this morning doing is talking a bit about a book that was recently published entitled Accountable Marketing, Linking Marketing Actions to Financial Performance. This is a book that has its genesis in the Marketing Accountability Standards Board and its work over the past decade or so. And what I'd like to do is to give you a high-level look at the contents of the book, talk a bit about the motivation for the book, talk about the Marketing Accountability Standards Board and what it seeks to do, and then take you through an illustration of one of the projects that's described in the book, but is also illustrative of the kinds of work that MASB, the Marketing Accountability Standards Board, is engaged in. The motivation for the book was really to chronicle more than 10 years of work of MASB. That work has been particularly instrumental in trying to bring together marketing and finance. Part of our mission as an organization is to try to tie marketing and finance more closely together within organizations. But we also wanted this book to create a foundation for future work. All of the projects that are described in the book are actually still ongoing. So the book is really a progress report rather than a report of finished projects. MASB itself is an organization that was founded in 2007, although it has its roots that go back to 2004. It's really derived from the spirit of the quality movement that inspired ISO and the Association of the American National Standards Institute. We've modeled ourselves on other standard-setting bodies like the accounting organizations, FASB and IASB. We seek to be as an independent cross-industry forum that sets measurement and accountability standards for visionary leaders in marketing and in finance. Our charter members are depicted here. I won't go through them all, but it's a very impressive listing of corporations, universities, not-for-profit organizations such as MSI. We have a summit twice a year where we bring people together. It's an exciting day and a half that provokes a lot of interesting discussion. This is the book. There are 20 chapters. I won't take you through the total table of contents, but the contents deal with the motivation of MASB. We discuss the roots of MASB and the quality movement and what we can learn from the quality movement. And then we discuss a variety of projects that MASB has been involved in over the years. One of those is simply to create a common language. There was a publication about 10 years ago that found that the very same word, a word like persuasion, for example, was actually used in many different ways. In fact, many different ways even within the same organization. So a really good place to start in setting standards is to have an agreed upon vocabulary. And MASB has worked with a variety of organizations, including MSI and the American Marketing Association, to create a set of standards around the meaning of terms that we all use on a daily basis. The book also deals with return on brand investment, lifetime value of the customer, social media, the relationship of marketing and finance, so a variety of reporting issues, and a variety of organizational issues, because what has become very clear over the decade that MASB has been in operation is that while it's important to have measures, while it's important to have standards, a lot of the issues are really issues of process in the organization. A lot of the issues are really issues of governance within the organization. And so it's really important to understand the organizational dynamics that go into making marketing an accountable discipline and assuring that it makes a contribution to the financial performance of the firm. This is the MASB Mandate. One of the things that has happened over the last 25 years or so is a dramatic shift in the nature of the assets of the firm. 25 years ago, less than 20% of the assets of firms were in intangibles like brands. Today, that figure is closer to 80%. So we've seen a dramatic shift from assets that are present in equipment and buildings and in hard goods, and much more of the value of the firm being found in intangibles such as the brand. Curiously, though, we don't really have a way of putting brands on the balance sheet or even reporting on the health of brands when we make reports to shareholders. So MASB is really engaged in a global investment in building brands, and we're partnering with a number of organizations to do that. We believe that this is really key to being accountable, and it's also key to determining whether investments in marketing are actually adding to the value of the enterprise. This notion of accountability is really quite important. A number of organizations have placed it number one or number two in their list of priorities. For example, the Association of National Advertisers has ranked accountability as number one or number two in its priorities over the last 9 years. We also know that CMOs are planning to invest more in accountability and having the right measures and metrics in place over the next several years. So this is clearly an area that has obtained a lot of attention from organizations, and we hope that our book will contribute to best practices in this arena and will stimulate further work. Our problem in marketing is not that we lack measures. In fact, as one of our members pointed out some time ago, marketing really is kind of swimming in measures. The problem is that we tend to lack standard measures and metrics, and in fact, in many cases, even common vocabulary. And it's certainly the case that the metrics that we use, which are certainly useful, but in many cases are lacking explicit links to financial performance in predictable ways, need to be supplemented with measures that are in fact more closely linked to financial performance. In many areas, we also lack formal processes for even auditing marketing metrics and marketing models to determine whether or not they are really helpful, whether they are the best that may be available, and whether they are really making an important contribution to decision making. And finally, a lot of the metrics that we use tend to be highly idiosyncratic. Idiosyncratic to the firm, sometimes even idiosyncratic to the business unit within the firm. And it's really impossible to improve a process until you've defined the process. So part of what we're seeking to do in MASB, and part of what we talk about in the MASB book, is to move beyond the idiosyncratic to create some well-accepted, validated standards. Absent those standards, our credibility suffers because we simply are unable to demonstrate the contribution that we're making. Those standards really need to be financial metrics. We need to be able to translate our marketing measures into financial performance, and there are really good reasons for that. And first of all, finance is the language of the company, for better or for worse. The reason that that's the case is financial metrics are the way companies have to report, and it's the way that they are evaluated in the marketplace by owners and shareholders. But there are other reasons why financial metrics are important. It's really the only way to compare alternative actions. CEOs, CFOs have to make decisions about whether to invest in building a brand in Indonesia or building distribution channels in Brazil. There's really a need for metrics that allow us to make decisions across products, across markets, and across customers. And the only way we're really able to do that is by translating our marketing measures into measures of financial performance. Financial metrics also provide a means for accountability, and accountability in terms that the marketplace understands. They provide a means for organizational learning and for cross-functional teamwork, since financial metrics are common and are shared across organizations and across functions. And finally, marketing metrics or financial metrics provide a way to answer questions about the optimal marketing mix. I mean, ultimately, what one does in marketing needs to be translated into some type of financial outcome, so that you can then compare the costs of one marketing program to the costs of another marketing program and lay that beside the likely financial return of those two programs. In many ways, marketing today is about where quality was 50 years ago. Highly idiosyncratic, often viewed as a cost rather than an investment, often lacking in standard metrics, often lacking in standard processes. This was certainly the case in operations 75 years ago, 50 years ago. And for the last 70 years, people in operations, people in quality have been proving themselves. They've been developing standardized metrics, been creating standard processes, linking those processes and metrics to financial performance, and really demonstrating their value. 70 years ago, people would have talked about operations in highly idiosyncratic fashion, and would have probably bridled at the thought that the same processes could be applied in pharmaceuticals as in financial services. And yet today, you see processes like Six Sigma that have been adopted across a whole range of organizations that differ in operational details that differ in their market, that differ in the product offerings, but still the processes are applicable. We need to do the same thing in marketing. We need to develop a set of broader standards, both in terms of metrics and in terms of processes that will allow us to learn, will allow us to hold ourselves accountable, and create accountability for the marketing organization. The reality is that everyone agrees that marketing creates some value. Our problem is quantifying that value. And when we begin to think about quantifying value created by marketing, we actually create value in numerous ways. We often sell ourselves short when we talk about the value we're going to create. It's certainly the case that we create value in the short term. We run an advertising campaign, a promotion campaign, and we get incremental effects, incremental sales. That's an important contribution, and it's an area, in fact, that we do pretty well at in terms of measurement. We can show short-term gains pretty readily. But we create value for the firm in a variety of other ways. There are longer-term effects of marketing. We reset the baseline. We create incremental effects. We create things that have been called persistence effects. We change the market in fundamental ways that persist over time. Brand equity is a good example of that. When we create brand equity, that equity persists in the marketplace and allows us to charge a premium, allows us to capture market share, not just in the instant case in which we've run an ad promoting the brand, but in the longer term case where the value of that brand persists over time. And finally, often neglected in the context of the contribution that marketing makes is the creation of opportunities for the firm. Our friends in finance talk about real options. These are opportunities for the future. And economists actually tell us that about 50% of the value of most firms actually resides in the portfolio of options that the firm possesses. A really good example of a real option is a brand. When it's created a brand, you have the option, the opportunity to leverage that brand with extensions of that brand. You may choose not to exercise that option, but the option is clearly there and it has value. And part of what we need to do in marketing, part of what the book attempts to suggest, is that we need to become much more articulate as marketers about the ways in which we create value. Anyone who has sat through a proposal for a capital budgeting exercise knows that there are enormous numbers of assumptions and hypotheses that go into such presentations. We should not be embarrassed as marketers to make similar sorts of presentations, to make similar sorts of arguments, knowing well that there may be assumptions, there may be changes in the marketplace, but we have a very, very powerful story to tell. We create value in many ways, and we need to be very articulate about that. Ultimately, the metric that we need to link marketing to is cash flow. Cash flow is the primary financial metric of the firm. It's a measure that is consistent across markets, across products, across customers, across activities. And what we need to do in marketing, and again this is outlined in the book, is to identify sources of and to produce cash flow. In fact, one way to define marketing is as a set of activities that are involved in creating cash flow for the firm. So every marketing activity needs to be causally linked to these drivers and ultimately to cash flow. That doesn't mean that intermediate marketing metrics, awareness, brand equity or brand health measures, or any of the whole variety of other measures we use in marketing, doesn't mean that those are unimportant. We just need to complete the picture by linking those intermediate metrics to financial metrics in a causal fashion. The reality is that when we think about cash flow drivers, there are really three primary ways that the firm generates cash. One is through customer acquisition and retention, obtaining new customers or holding on to current customers. This is really about increasing and managing the customer base, and that's a primary activity of the marketing organization. We can also generate cash by increasing the share of wallet within a category. We may do this by increasing the frequency of purchasing relative to competition, or sometimes even increase the total consumption in the category. Here we're talking about increasing market share or the size of the category. And a final way that we may generate cash for the organization is share of wallet across categories, selling additional products or offerings to existing customers. This is really classic cross-selling. But if you think about marketing's activities, these are the things that marketing is seeking to achieve. We simply need to link more explicitly these activities and more intermediate outcomes to the generation of cash. What we've developed and we describe in the MASB book is a protocol that we call the Marketing Metric Audit Protocol that is a formal process for identifying drivers of cash flow, financial results, linking marketing activities to marketing metrics, linking those marketing metrics to drivers of cash flow, and then those linkages then give us a basis for identifying and testing assumptions about the validity of those assumptions and causality. In short, what we're talking about here is first trying to tell the story. This is how a particular marketing activity will generate cash. And then once we've told the story, really trying to put some hard numbers around it. So here's a simple example. There's a marketing activity. It may create particular intermediate marketing outcomes, maybe a shift in brand equity, maybe a shift in awareness, maybe a shift in the coverage by distribution. But those marketing activities should be linked to some sort of intermediate marketing outcome. But once we've identified those intermediate marketing outcomes that we're trying to influence, we can then begin to think about how do those intermediate marketing outcomes link to cash flow. How are we going to generate additional cash? Is it going to be through increasing market share? Is it going to be through increased lead generation? Maybe changes in purchase intent? Maybe distribution coverage? I mean, the list can get quite long. And when we do that, we can then sort of close the loop and link our marketing activity not only to the intermediate marketing outcomes, but ultimately to the cash flow drivers and ultimately cash flow for the firm. In thinking about the measures that we use, we need some standard by which to evaluate a particular metric. And in the book and in other work by MASB, we've identified 10 characteristics of an ideal metric, ranging from being relevant, they ought to address an important problem for the firm, they ought to be predictive, they ought to tell us about not what has happened in the past, that's useful, but they need to do more than that. They need to tell us what will happen if we take an action in terms of future results. We certainly need measures that are objective, well calibrated. We need measures that tend to be stable or reliable over time. Measures that are sensitive, and sensitivity is really very important because very small differences in the outcome of a marketing program, if we can detect them, could have significant impact at the marketplace level. But at the same time, we want measures that are relatively simple, uncomplicated, easy for people to understand. We certainly want measures that are useful in terms of suggesting ways that we might improve. We want measures that are transparent, consistent with the need for transparency in the firm, and we want the quality of those measures to be assured. There needs to be an ongoing process that assures the first 9 of these characteristics. The book itself largely describes a variety of projects. Much of the work of MASB is organized around specific projects addressing specific needs or specific gaps within the practice of marketing. Among the projects that are described, and I won't take you through all of them, are the Common Language Dictionary, our effort to eliminate ambiguity in just marketing terminology. We have a project on brand investment and valuation standards, and I'll give you a little bit of information about that in just a moment. We have a project on improving financial reporting. We have a project on continuous improvement in return. We're developing a metrics catalog, and we're trying to connect marketing metrics to financial metrics through the marketing metrics audit protocol. And we've now taken a number of measures that are in common use in the marketplace through that process. In fact, we just recently, in the last few days, have completed an audit of Nielsen's Bases new product forecasting system, and that report will be posted on the website. We've applied customer lifetime value to consumer packaged goods, and demonstrated how that particular metric can be reliably applied to CPG, and a variety of other projects. All of these, by the way, are ongoing. So what you have in the book is a progress report. We've tried to identify reasonable points in time for summary, but all of these projects are not completed by any means. They're ongoing. So one example of a project that we are engaged in, and there's a chapter in the book on this, is our brand investment and valuation project. Here, the project is concerned with establishing missing linkages between marketing and financial metrics and building a brand investment valuation model that any brand could use. And in order to complete this project, we brought together leading academics. We brought together specialists in a variety of research companies, Nielsen and MSW ARS in particular, and a whole host of finance and marketing practitioners in blue chip companies. In fact, we have 6 companies that have partnered with us and helped us generate about 18 months worth of data tracking brand value over time and linking that to sales. So here's kind of the nature of the tracking study in conceptual form. Whole variety of marketing activities that ultimately, we presume, and we've tested the proposition, contribute to customer brand strength or preference. That preference then we seek to link to such metrics as market share, sales volume, price support, the ability to command a premium. That in turn links to velocity, margin, leverage within the marketplace, and ultimately we can translate that into brand value. For those of you interested in the details, we've collected data over 18 months, essentially over 6 quarters, in 12 very diverse categories ranging from packaged goods to automobiles. We have data on 120 brands. We have a variety of financial and brand strength metrics. We have unit share, price, and distribution from each of our partners who are involved in the project. We have a brand preference measure that was provided by MSW ARS, and a variety of other marketing metrics that each of the participants provided. And a very robust sample. We're talking about 7,200 plus consumers for the measurement of preference across the various brands. And this is the conceptual framework for the piece of research. We sought to link marketing activities to a change in the brand preference choice tracking measure, which was provided by MSW ARS, then link those to market share, volume, price premium, and ultimately to cash flow. The measure itself, the brand tracking measure, as I mentioned, is provided by MSW ARS. It's a very simple measure. It simply presents the consumer with a variety of pictures of products in the category, and the consumer simply selects which one they would buy on a particular occasion. This is a methodology that isolates brand strength by holding everything else constant, price, promotion, shelf position, and so forth. What we found was a very strong link between the brand preference measure and the unit share in terms of market share. You'll see the illustration here. This was not category specific. We found a very strong relationship in each of the 12 categories that we examined. In fact, the correlation between the brand preference metric and unit share was 0.88. And when you account for price differentials and distribution coverage differences, the correlation reaches 0.94, which is a very, very strong relationship, something that we can be very confident in, something that allows us to tell a very powerful story. We also linked brand preference and other marketing metrics to a variety of other measures. And the other measures also have relationships to brand preference and to unit share, but none come close to the relationship that we find with our one very simple little measure. So what we've been able to do is basically create a conceptual model that links our brand activities to a measure of brand strength, and then link the brand strength measure to a variety of other marketing and financial outcomes. This is the conceptual model. For those of you interested in the math, you can actually turn the model into actual numbers, including cash flow, by applying the equations that are here. The numbers here actually correspond to the numbers in the conceptual picture. We also generated a number of case studies in addition to the data collection. That these case studies demonstrate the relationship between long-term brand investment and valuation. A number of these are actually reviewed in the MASB book. But ultimately, what we learned from applying the brand investment valuation model and the research associated with it was that brand preference is a very strong indicator of brand strength. A simple metric that we used explains about 88% of the variance in unit share when you account for price and distribution. Certainly captures the impact of other marketing metrics. So it's really a practical model for brand valuation. It uses the present value of cash flows to align with other assets. It provides a consistent means to track brand values over time. And we've generated a number of case studies that reveal the power of this approach to managing brand investment. So that's a quick overview of what's in the book. If you're interested in learning more about MASB and its work, if you're interested in learning more about what we have learned over 10 years of effort, I encourage you, first of all, to read the book. It's available on Amazon. The publisher is Routledge. You can get the book on the Rutledge website as well. It's available in hardcover, in softcover, and as an ebook. If you're interested in learning more about MASB, visit the website. It's very simple, themasb.org. If you're interested in perhaps learning more about being a member of MASB, I would invite you to contact our membership director, who is John Willard, and his email address is here. And as I mentioned at the outset of the presentation, twice a year MASB has a summit, a day and a half. The next one is in Atlanta, just before the meeting of the American Marketing Association. And if you'd like to attend, do feel free to contact me or contact John, and we'll see if we can arrange for you to be a guest and have the opportunity to get firsthand experience with the very exciting and informative presentations that occur there. On that note, I'm going to say thank you, and I'll be happy to answer any questions you may have, either now or my email address is present on this slide. Be happy to respond to email questions that you may have after the presentation. Questions?
Great. Thanks a lot, Dave. That was an amazing overview of 10 years' worth of effort. I've been fortunate to be part of that and see how that was done over the years, and I think you did a nice summary in the book. Again, I highly recommend to those attending the webinar is more detail on the topics that Dave touched on. I should also point out that the archive of this webinar will be on our website. Within a day or two, you'll receive a follow-up email with a link. So for those charts that were more detailed and had the formulas in the behind the conceptual model, for those of you so inclined, you'll be able to download the actual presentation and do that at your leisure. We do have some questions, and I want to start maybe by asking a question that may be occurring to some of the folks in the audience who are from marketing services providers or perhaps from the buyer side that use those types of services. And tell us a little bit more about this, the marketing metrics audit protocol. The idea there is to demonstrate that the metric does measure what it claims to measure, that it meets at least most of those criteria that you laid out. What happens next then? What would be the incentive for a marketing services company to put one of its metrics through the protocol?
A really good question. What we're really asking metrics providers to do is to kind of let us look under the hood. Let us verify, validate the claims that are made for the model. The incentive is really found in transparency. To the extent that an independent body has had the opportunity to look at the measure, to look at its relationship to financial results, one can place more confidence in that measure. When we go through the audit, we don't require that firms provide, at least for public consumption, proprietary information. We do ask that they provide it to the audit team, but that's a relatively small group. And so there is a way for firms that want to go through the audit process to protect their proprietary processes and technology, but also get kind of a third-party seal of approval that says the metric does work as advertised, the metric is useful. It's also very useful for the firms in terms of learning. Several of the firms that have gone through this audit have actually made some changes in their processes or in their measures based on feedback they've received from the audit process. So there's a real opportunity here for learning on the part of the metrics organizations, as well as creating greater transparency and greater credibility in the marketplace. Great,
thanks. On that subject too, I think we both know that the mission of MASB is to establish these standards and protocol for vetting metrics and generally bringing to the attention of both marketing and finance the need for this common language. As you said, for better or for worse, finance is the language of companies. They're obliged to report that way for SEC and other regulations. What are your thoughts about how we as marketers can move this ahead? There's obviously an incentive for the individual services companies to maybe have their metrics vetted and you'll be proven, as you were describing it just now. But what are some of the reasons why companies ought to adopt this approach, and maybe importantly, what are some of the barriers or challenges that you see from a practical standpoint getting companies to actually align marketing and finance along the lines you've talked about?
Really good question. I think at the firm level, the reason for embracing these processes is for much the same reason that we find in the quality movement. What we're looking for are ways to be more effective and more efficient. And to the extent that we can more closely link our marketing activities, the costs associated with those marketing activities, the outcomes in terms of changes in the marketplace to the financial performance of the firm, then the firm will get better over time. Its performance will improve. So there's a very strong incentive, I think, for the firm to do this, and indeed there's enormous pressure on marketing as a discipline that comes from the board, comes from the CEO, comes from the CFO to better demonstrate how marketing and the substantial investment that is made in marketing is in fact contributing to the financial performance of the firm. I think for the marketing discipline, this is a way for marketing to enhance its credibility, enhance its influence within the firm, to earn a seat at the strategy table, and be much more valued as a contributor to the financial performance of the firm, rather than simply being a service provider. And finally, there is an incentive, I think, for us as individual marketers to be able to demonstrate that we have an understanding of the broader mission of the organization with which we're affiliated, and that we're able to actually, first of all, tell a story about how our activities actually make a contribution to that larger objective of the firm, and then to add credibility by demonstrating that we can put some hard numbers to that story.
That's great. It certainly chimes with what we're hearing from MSI members about the challenges they face, and the getting marketing the proverbial seat at the table in the C-suite. And I want to remind the audience, come back to something you said about the ways that marketing creates value. That third idea being the real options notion. I think that's something that we don't talk about enough, and as you said, perhaps should be a little bit more ambitious or courageous in presenting the value to the organization of creating those types of options for future action. In our MASB discussions from time to time, we've talked about the value of marketing as in risk management. It's another one of those terms and ways of thinking that bring together finance and marketing. Marketing can actually mitigate the risk of making decisions if it's done properly, and that's something the finance folks can appreciate. We have a question from Renee about whether or not the model that you described earlier has been vetted for B2B as well as B2C. You mentioned we had a quite diverse range of categories, but they appeared to be mostly B2B or B2C categories and sales situations. Any comment about that?
It is correct that the categories that we've looked at thus far are really consumer products. It's a wide range of consumer products, ranging from packaged goods to automobiles, but we have not yet vetted it in a business-to-business context. But we'd be delighted if we had some companies that would come forward and volunteer to work with us in extending the project to the B2B sphere.
Yeah, there's no reason why the conceptual model couldn't be applied. Obviously, the decision process is different, more parties involved and so forth, but the conceptual framework ought to hold even in that situation, right?
Exactly, that's correct.
We have an interesting question, or maybe a sort of a suggestion from Harish. He says, have you thought about adding a perspective on organizational behavior when you look at the marketing finance link? You know, part of what happens in organizations, and you alluded to this at a couple of points, is, you know, finance has its terms, marketing has terms. We're trying to find common ground, but obviously these discussions take place in the context of organizational structures and things. And he specifically wondered if it might be possible to see that some organizations are better at creating a creative environment, a so-called learning organization that results in more successful new product launches and innovation. So I thought about the role of kind of organizational issues as we think about trying to find this common language and get organizations to adopt these standards.
Yeah, there are actually several chapters in the MASB book that really deal with organizational issues and process issues. And what has become very clear over time is that many of the issues are not so much issues of metrics per se. Those are important, but they are issues of governance. They are issues of organizational dynamics. And much as the quality movement has sort of moved into the organizational sphere as well, out of recognition that you've got to change an organization, you've got to change a culture in order to affect some of the practices that influence quality. The same is true for marketing. If we're going to adopt best practices, if we're going to adopt standards of performance measurement, that's going to require changes in how the organization operates. It'll require changes in how disciplines within the organization, specifically finance and marketing, but others as well, interact with one another, and it will require us learning what types of organizations and organizational processes really facilitate a better application of marketing. So there's definitely an organizational component here, and definitely an opportunity to learn more about the influence of the organization itself.
That's great. And as you know very well, Dave, and maybe the audience as well, MSI, among others, have supported a lot of academic research on this subject. There's really quite a rich literature on market orientation, customer orientation, being organized for innovation and new product development. So there's some good lessons learned, and I think we have sort of some of the answers and some of the tools to make this connection that you were describing. So it was a good question and a good thought there. There was an earlier sort of definitional question that I wanted to get to. Jim raised a point about the definition of cash flow. Is that different in your mind from the net present value of incremental sales? The suggestion was it might be easier for marketers to manage profits from incremental sales. And so I wonder if you have any clarification on that use of cash flow in the model and how it does or does not differ from net present value of incremental.
Well, certainly net present value of incremental sales would be a very useful metric. It may be a simpler metric, easier to get to for many organizations. The problem with that, however, is the focus on incremental. In many categories, particularly mature categories, just holding your own may actually be a sign of success. So I think we need to be careful about defining success solely in terms of incremental. Many marketing activities are defensive, and they're really intended to let us hold on to the sales that we have, let us retain current customers. But certainly incremental, net present value of incremental sales would be a very useful metric. It just, I think, is incomplete.
Okay, thanks. There was a question raised a moment ago about another sort of key player in this equation and getting finance and marketing together and getting on the same page, and that is the role of financial analyst. And if I'm interpreting Melissa's question correctly here, it has to do then with the role of financial analysts from third parties, making recommendations perhaps about investments and stock value and that sort of thing. Since you do work in the area of public policy and regulatory issues related to marketing, maybe just your broader thoughts about this issue, about what is to be gained by this, perhaps, and maybe are there any challenges or pitfalls that we think about moving more towards this marketing accountability as it relates to the role of financial analysts and how they affect things like stock value?
Well, certainly financial analysts play a major role. We've actually had some analysts speak to us at our MASB summits. As we have moved into a world where the majority of the value of a company rests in its intangibles, and one of those intangibles, perhaps the most important of those intangibles for many companies, is the brand or brands. Analysts paid much more attention to the issue of brand and brand management. They would like more information on how the firm is managing its brands, how the firm is increasing the value, or at least protecting the value of its brands. So I think you're going to see much more emphasis from the analysts. I think you're also going to see more emphasis coming from other standard setters and regulatory bodies. ISO has a committee that is actively working at the international level on brand evaluation. And just as an aside, that committee is being driven largely by the Chinese, who have figured out that they can't be low-cost providers forever, that they need to be investing in building brands as well. So I think you're going to see a lot more emphasis on brands and brand valuation. The challenge is we have not had a standard. If you don't have a standard, it's kind of hard to report something that's useful. But I think part of what MASB has been doing, particularly through its brand investment evaluation project and through its financial reporting project, is to really move us in the direction of a common standard that would allow us to communicate more usefully to those analysts.
That's great. Let me ask maybe as one last kind of closing thought from you to maybe extend your remarks just now. As I think we know, and maybe others, MASB was modeled on the Financial Accounting Standards Board. We've had presentations from them at MASB meetings, and the idea there, as I understand it, was that several years ago, the financial industry realized it had to have a common language and common standards for metrics and terms, or regulation might be imposed from the outside, and the concern was that might be more harmful than helpful. So it became a kind of a self-regulatory movement, you might say, and I think there's a similar impetus behind MASB. Just your thoughts about the proper balance there of how much of this has to come from the industry side. Is there a role for government regulation to play here? Is that a concern if, in fact, the industry doesn't take steps along the lines that MASB is doing to become more transparent, as you mentioned, in reporting and that sort of thing? So just maybe the broader context within which this discussion is happening.
Sure. Well, you're correct that FASB really grew out of concern for standards and a concern that government would become the primary regulator. And so the industry created an organization to do self-regulation. FASB has has an advantage that MASB does not, at least at the moment, and that is FASB works very closely with the Security Exchange Commission, and so it has kind of quasi-government authority. MASB hasn't reached that point, although given the increasing importance of brand to the value of companies, it is certainly the case that government organizations are giving much greater scrutiny to the marketing dimensions and brand dimensions of financial reporting. So I think we're likely to see ourselves over the next 5 or 10 years having more dialogue with government regulators and really trying to sort through how much of this can be done in a self-regulatory fashion and how much of it, is going to be done by government. We already have an organization, the Media Ratings Council, that is an industry-supported self-regulatory body that is concerned with auditing ratings and subscriptions, and that actually grew out of concern that government was going to start regulating that arena, and by creating the council, it really avoided having the heavy hand of government become a part of the regulatory process. My personal feeling is that we would be better off if we can create our own self-regulatory standards rather than having them imposed by folks in government who of necessity have to create very general standards and regulations that apply to everybody, rather than what we may be able to do in a self-regulatory environment, where we can recognize the idiosyncrasies of individual businesses and industries. And to some extent, that's what FASB is able to do, is to develop multiple guidelines that may apply to some industries, may not be applicable to other industries, but really recognizes the idiosyncrasy of the business operation.
Well, that's great, Dave. You've given us a roadmap and a call to action, I think, as an industry to, as you said at the outset, to be transparent about how we measure marketing accountability and the value that will achieve, and avoid maybe some of the difficulties that might otherwise arise. So again, I want to thank you very much. For those of you whose questions we did not get to, or if you have additional questions you'd like to direct to Dave, again, you have his email address on the presentation. There will be a follow-up email with links where you can download the presentation and view the archived webinar. We encourage you to share that with your colleagues who are not able to make it live today. Our next webinar will be how multi-touch attribution is transforming marketing decision-making, with Michael Coleman of Convertro and Scott Breitenother of Casper. That'll be on June 7th at 1 p.m. And again, details are on our website on the webinar tab in the upcoming events. We'll look forward to seeing you there. And many thanks again to the members of the MSI audience for participating in our member-to-member webinar series. And again, our thanks to Dave Stewart for our presentation today.